host, Miss T. I'm here with another episode of Tea with T. This is my second webisode of Tea with T, and today we are going to talk about this payroll tax hike, what you can do throughout the year to put that money back in your pocket. So we're going to get started on that. First, let's feature tea. Is Yogi tea. I love Yogi tea. This is one of my new favorites, thanks to one of my girls that put me on. Yeah, blueberry. It's a green tea, but it's blueberry Slim Life, I think it's called. Yes, blueberry Slim Life, and it tastes like blueberries. It's so delicious. It does say it energizes and supports a dieting program. I'm not on a diet. I just love the way this tastes, and if it detoxes me, and I shed a few pounds around the midsection, I could use them. Trust me, to be gone. So let's jump right into it. So today we're going to talk about, and I have notes here because I need to kind of make sure I cover all my bases. And it's going to be a really vague segment. I'm not going to go into too many details because there's another, that's another Tea with Tea segment I want to do, is to go into details of some of the things I'm going to talk about. But today we're just going to speak about this payroll tax hike. Now if you make $50,000 and above, your taxes will be going up $1,000 throughout the year. That it seems like that's $1,000 is a lot of money. I'm not gonna act like $1,000 isn't a lot of money, but $1,000 over the course of a year is not that bad. Taxes go up. That's the way our economy works. We pay into our economy with our taxes. It's something that economists argue about. Is it better to pay a large sum at the end of the year, or refund a large sum at the end of the year, or make Americans pay for it in sales taxes? The way our economy's been working is to have an income tax day at the once a year. That's the way it works. We're going to either have to pay more into these taxes or we get cuts. And so I'm going to describe how you can get some tax credits, some tax deductions. Tax credits and tax deductions are two different things. Let's discuss that first. A tax credit reduces your amount of income that is taxed. Your deduction is what lessens the amount of income that you either pay or that you either get back. So those are the two differences between a tax credit and tax deduction. Make sure you understand those. Let me also start out by saying that I am not an accountant. I am not a CPA. I am not a tax advisor. I am not licensed to sell stocks, annuities, and bonds. I am a banker, consumer banker, small business banker. I can only give you advice onto what you should do. You only know your finances, so only you are going to be able to make the executive decision on what you should do. But again, I'm just here to inform you. You can call me Informative T, because that's what I'm going to be here to do for you guys. Inform you, try to direct you, try to steer you in the right direction. But it's totally up to you what you feel is necessary for your own individual finances. The information that I'm going to give you today is going to be information that I would give to any of my banking clients, whether they got big money, whether they got small money. So, you know, you kind of take my advice and you apply it to your life, but please take my advice. So again, you have your tax credits and tax deductions. So at the end of the year when you file your taxes, a tax credit, of course, it's much better than a tax deduction because it lessens the amount of your taxable income. So you want to try to work with a CPA and see how, for your individual situation, whether you have a wife, whether you have kids, whether you just own a home, whether you're single, work with a CPA or a tax advisor to figure out what's going to be in your best interest. You got to make a plan. Plan your years. You know how much you get a year. You know what your salary is going to be about. A lot of us get bonuses. A lot of us work hourly. A lot of us are salaried. So you kind of want to definitely always have a plan. Make goals for your fiscal year. What do you want to accomplish this year? And so for the payroll tax hike, I'm going to kind of advise you on how to put the money back into your pocket. The biggest thing, number one, is save for your retirement. I know you guys hear these terms thrown around, 401k, IRA. I'm gonna do a separate video on retirement accounts because that's something that I did specialize in for my consumers and small businesses. However, this is just going to kind of give you, this video is just to give you a gist of what you can do. save for your retirement, plan for your retirement. And the reason why I say this is not just to get the tax deduction for your 401k, because you do get to claim that as a deduction on your taxes at the end of the year, whatever you've saved. But the real reason why we're having these payroll tax hikes is because we do have to support elders and people who are living off of Social Security. These people either didn't save enough for their retirement and they're getting a little bit of the chunk, or they didn't save anything for their retirement and they need this money to survive. They count on the government to survive. So we can either be the people to complain and say, hey, I don't want to support these people, this is blasphemy. But as Americans, we're supposed to be patriots. We're supposed to look out for our fellow people, whether black, white, yellow, brown, whatever the case may be. So this is what we do as Americans. We pay taxes. So what you can do to avoid being 69, 70, 55, I think the average retirement age is about 55, 60. And that's when you can start to pull from your 401ks and your Roth IRAs and things like that. You gotta save. You just gotta save for, if you're working, I don't care if you're 18 or 30, you need to start a retirement account. Okay, T, my job doesn't offer retirement accounts. A lot of large corporations do offer retirement accounts, and they offer a matching program where they will match up to a certain amount of what you pay into your retirement account. It's great. You get matched. You get a wide variety of investment options, and you get an investment company that comes along with your with being able to invest in your retirement through your payroll. And you get to kind of start to, I like the matching option. I think that's the biggest thing with the jobs now, with the corporations supplying 401ks and Roth IRAs for their employees, is because they match a certain amount. I think when I worked for Chase, they used to match up to 5%, so I always put up to 5%. I always made sure I maxed out at 5%, at least, because that's what they matched of my payroll. And the way that works is they take before your money is taxed, which is great because that lessens the amount that you're taxed. They take that 5% out and they put it in a retirement account for you. Now that is going to seem like a lot of money. You can do 2%, you can do 3%. When I started, I was 18. When I started my retirement account, I was about 21. I started with 3%, and that's because they matched it. And then as I got older and started making more money, I went to 5%, and that lessened the amount of money that I was taxed at the end of the year. It was great for me because I was single, I had no kids, I didn't own a home. That was the only deduction I was able to take, was my 401k. Later on down the line, I opened a Roth IRA, which the Roth IRA pulls a certain amount that you would like to invest in a Roth IRA. It takes a certain amount, certain percentage. I used to do 3% because the Roth IRA is not matched through the company because it's extra. I used to take 3% of my funds after taxes. So that's a little bit more additional money that, you have to put away, but it was an additional tax deduction for me, which helped a lot because I made a lot of money when I was a banker because I had a bonus. I had a monthly bonus that I earned. And I didn't have any deductions, I didn't have any kids to claim at the end of the year, and it just worked for me to lessen the amount of taxes that I owed at the end of the year, because unfortunately I still ended up owing. Never was a lot, but I still ended up owing. So 401k, if you have a 401k, Roth IRA, put 3% in there. That'll help you with an additional deduction. Now, if your job does not offer a 401k, talk to your local bank. Local banks offer 401ks and Roth IRAs. They offer them in the form of savings account. Again, I'm going to go into details on 401ks on a different video, but this is just to let you know what you can do to save yourself, put that money back into your pocket. So you can go to your local bank, get a relationship with your local banker. I didn't care how much money my people were making. If they're my client, we had a relationship. You can always call on me. You can always sit and talk to me about planning your future, your goals for your future. So again, have a relationship with your banker. Go into the bank, tell them you want to talk about retirement options. A lot of them have savings account options. You can put that money into a CD that you have to roll over every couple of months or whatever that term is, and that money's untouchable, but you're saving for your retirement. Now the money could be touchable if you needed it. I'm going to talk about that in a separate video. I'm not here to talk exclusively about 401ks today, but that is the number one thing. If you are working, I don't care if it's McDonald's or if it's, you're a CEO somewhere, you need retirement accounts. Those are tax deductions that are going to lessen the amount of taxes you have to end up paying or you get back at the end of the year. Other deductions that you can take are charitable donations. They have to be over a certain amount. But I still, you know, I still donate to the thrift store and I still get my receipts and we still claim on the taxes because every little bit counts. If you can afford to donate to charities that, you know, when we have these disaster reliefs and things like that, because it seems like we're always having some type of natural disaster now with our ecosystem. And so if you can afford to give an extra $100 or $2 to these particular places, do it, because you know, you get a tax deduction at the end of the year. People say don't do it just to get a deduction, but at this end of the year you need to you know, look out for yourself, and this is a great way to do it. If you own a home, you have different property taxes, different things, talk to a CPA. Talk to your income tax advisors. I know we just like to go to the income tax office and get it done. Get you somebody that's going to be someone that's informative, that's doing your taxes, that's going to speak with you about what you can do to change for the next year. Because income taxes come around once a year. A year goes like that. You need to have these type of people in your corner who's going to help you out. H&R Block and them, I know they're, you know, everybody wants to do their taxes themselves. Get you a tax preparer that's going to talk to you. Throughout the year too. Get you someone that's going to give you great advice. Go to seminars, do your research. Like that's what I'm going to be here for, to help you guys. I'm going to inform you about every little thing you need to know throughout the year. Trust me. I'm going to be here. We're going to keep doing these things. Find your way to get you some tax credits. Again, the tax credits reduces your dollar amount, your tax dollar, and tax credits could be, you know, anyway from you paying into tuition. Plan for these things. Keep yourself, you know, in the know of, okay, this may be a tax credit, buying a new car, buying a new home. I think a new car is a tax deduction. Buying a new home is a tax credit because you get credits for property taxes and things like that. Again, I'm not a CPA. I don't go every year. I don't go over what could be a tax credit, but I do look out for my family and thinking, you know, what is a tax credit? What is a tax deduction? The Mr. and I are both in school, paying out of pocket, so we get those tax credits for when we buy school supplies. We just bought a new computer. We were able to, well, we bought it last year, so we were able to claim it on the taxes this year. And things like that. So definitely talk to your CPA to know what's going to be a tax deduction for you, what's going to be a tax credit, what's going to work best for your individual situation. So adjust your spending habits. This is going to be a hard pill for a lot of people to swallow because, you know, we all want to have certain things. We want to live a certain lifestyle. We want to, you know, just have things for our life, live. And so, but adjusting your spending habits is going, if you're having a problem, if you're having a hard time swallowing the fact that you got to pay an extra $1,000 in taxes throughout the year, then it's time to look in the mirror and say, okay, maybe I need to do some things differently. And that will be adjusting your spending habits. Well, Toya, how do I adjust my spending habits? What do I need to do? You need to know where your money's going. Monthly budget. You know what's coming into your house a month and what's going out. So what's going in, what's coming out. That way you can figure out where to make certain cuts and changes. You know, a household budget for all your expenses. Your bills, write down the most important first to the ones you could do without, and you can chip away there. Credit card should be high on your list. Utilities and credit cards should be high on your list. Whatever your higher interest rated is, your most important, highest interest rated, to less important, you know, and less interest rate. That way you know where to allocate the additional funds. I'm going to do a video on budgeting as well. That's simple, guys. Just those 3 things will help you to put that money back into your pockets. If you don't want to do them, don't say I didn't tell you. But save for your retirement, talk to a CPA, see what you can do to maximize on your tax credits and tax deductions, and adjust your spending habits. If that $1,000 is going to hurt you, adjust those spending habits to make sure that you can get that money put right back into your pockets, or keep it in your pockets at least. The leftover money that you do have, keep that in your pockets. So that's pretty much it with tea for the day. Thanks for hanging with me. Thanks for watching. Like, comment, rate, subscribe. Let me know if you have any questions. Email me, tweet me, Facebook me, comment here.